Ladies and gentlemen, good afternoon. I'm Paul Mullins, one of the directors at Kallanish, and on behalf of me and my colleagues, I'd like to say a big welcome to this afternoon's Global Steel Markets webinar for June. What we're going to do this afternoon, we're going to run through 4 presentations from our regional editors. So we'll kick off on home territory with my colleague Emanuele Norsa, who's based in Milan, who'll give an overview of all things European. Then we'll move to the Far East, where Tomas Gutierrez will update us on what's happening in Asia. We'll then head to Pittsburgh, where my colleague Dan Hilliard will give us an overview of all things North American. And then we'll move to the Middle East, where Adam Smith will give us an overview of the GCC countries and the CIS. This afternoon, we've scheduled 75 minutes. Each presentation should last probably between 10 and 15 minutes. And at the end of it, we'll bring back everybody for a question and answer session. So if you look to the right of your screens, you should hopefully see a dashboard. And there you'll see that you've got options of audio and questions. And during the presentations, if you click on the questions, you'll be able to submit a question. We won't answer them during each presentation, but as I said, at the end, we'll bring everybody together and have a little panel, and hopefully we'll get through as many questions as possible. And then what we'll do afterwards, we'll get back to you in writing with the answers to the questions that we haven't managed to deal with. So without any further ado, I'm going to hand over to my colleague Emanuele Norsa in Milan, and he's going to give us an update on the European market. Thank you.
Thanks a lot, Paul, and hello to everyone, and thank you for joining us today. I hope you can hear me well from Milan. I'm just going to go through very quickly the situation of the European steel prices, and in particular, I'm interested in the fact on how they're lagging behind the recovery that we're seeing actually in many parts of the world. And this is happening despite trade barriers being new trade barriers being announced at the moment across Europe. So we start, of course, with the first chart, and this is HRC globally. You can see these are prices from Kallanish. You can see the China FOB, the North American price, and the Turkish prices all recovering from the low that they hit in April. The yellow line, on the other hand, which is the Northern European HRC, is not recovering yet. It's still under pressure. We know something is this week. We just reported yesterday, actually, that ArcelorMittal is coming out with a price increase announced, but still the price. The chart is showing that prices are not recovering yet. And the same is happening with rebar. With rebar is even more accentuated in a way. So you see Chinese rebar recovering from the low hit in April, and the same happening in Turkey as well, in line with scrap prices. And again, in Northern Europe, rebar prices remain under pressure. Why is that? And we'll see it. Of course, we all know that the pressure on the European market started already at the end of last year. This is a chart, an image that you all know. So last year, overall, the steel using sector anyway were down -0.2%, and the biggest pressure was on automotive, as we all know, according to the Eurofair data, 6.9% down compared to 2018. What is interesting, of course, even in the real steel consumption last year, we noted a -2.6%, with the big drop mainly seen in Q3 and Q4 of 2009. So we entered 2020 already with a weak market, and of course, coronavirus accentuated the situation. The outlook is quite bleak, as we could imagine, for this year, for 2020. This is, as you can see down there, the outlook from World Steel. Next year, we expect a recovery, but still not yet back to recovering what we will lose this year, and also what we lost already last year. So now let's see why this is happening. It's funny enough, I mean, raw material prices are recovering in line with what's happening everywhere in the world with iron ore and scrap. This is the chart of scrap in Rotterdam and in Italy. You can see that scrap anyway from the beginning of April showed a clear recovery. So fundamentals like raw material costs are going up, but steel prices are not yet recovering. Of course, this will have an impact profitability of mills. Now I will ask Paul and Bijan, please, to put out a poll that we all would like to ask you. And yes, the poll is as you can see, when will North European HRC prices return above 450 euros ex-works? You can choose from Q3 2020, Q4 2020, or not before 2021. I will leave it to you to decide, and then we'll comment it together.
Thank you very much, Emanuele. We can see the votes coming in the background. At the moment, I reckon we're at 55% of people voted already. We'll give it another 10-15 seconds, let people get through there. As I mentioned at the beginning, the voting option, 3 options: Q3 2020, Q4 2020, and not before 2021. So we're going to close the poll in a second or two. 2 last seconds. Going, gone. Right. We see the results now, Emanuele?
Yes, so the results are not before 2021. Almost half of the people voting said not before 2021, but a good amount were also a little bit more positive with Q4 2020. The interesting thing is, I would have voted Q4 2020 as well. We all know, we all read probably in Kallanish today, we published it yesterday, that ArcelorMittal is coming out with new offers at 440 ex-works for Northern Europe, so trying to get back to the 450 level. Of course, transactions are still somewhere around 400 euros, so there is a lot of room to go back. But if the situation remains the same and iron ore remains above $100 in China for a little bit more, there is no reason why European HRC prices shouldn't increase. And also, and so we can close the poll, and I will continue with the presentation. Thank you. And of course, on top of that, we have to remember what's happening, which is the imposition of new anti-dumping duties and countervailing duties, for example, on HRC from Turkey, which is going to change massively the market for sure, because Turkey became the biggest supplier for HRC after the latest anti-dumpings were imposed on China, on Russia, on most of the other suppliers. And on top of that, of course, we have the safeguard review. From the 1st of July, we are waiting in a matter of days the official confirmation, but the Commission is putting more restrictions. So it's putting all country-specific quotas, for example, managed quarterly, and HRC quotas will be moved from general to country-specific. So we don't go as far as what Eurofair asked at the beginning, which was a 75% drop of quotas, but we're still putting new limitation to the safeguard. And just to give you an idea, look here, Rebar and HRC. On the Rebar side, you see that Turkey for July 2020, June 2021 had 304,000 tons of quotas available. Now these quotas will be split into 75,000 each quarter, which means that it cannot happen what happened last year, that in 3 days we used the complete full set of quotas for a year, which also means, of course, that people that bought in advance and were ready to use their volumes now that the new quotas arrive will not be able to do so unless they want to pay 25%. So, and the same goes with HRC. We go from 8.7 million available in the full year to only 340,000 more or less each quarter for Turkey, and Russia will be actually the one with the most quota available. So clearly there will be more possibilities for domestic suppliers to regain market share, of course, provided that demand recovers in a way. So I'm just concluding here with the last slide, which is, of course, for HRC. This is just to give you an idea. Just to have you an idea, on below you can see how much monthly it was imported in 2019. Turkey imported 231,000 every month during 2019, and now it only has 340,000 every quarter, every 3 months. So definitely the impact will be on Turkey, will be on Serbia, will be on India. Maybe Russia will be a winner in this case, which is odd enough given that they already have an anti-dumping on HRC imports. Okay, I will leave it to back to Paul. Thank you very much, and I will be available for questions later. Thank you.
Thank you very much, Emanuele, and really interesting, but also well done for respecting time on that. What we'll do now, as I said, we'll move further east to Tomas Gutierrez, editor for Asia, and Thomas is going to give us an overview of all things Asia with a strong focus on China. Thomas, over to you.
Thanks, Paul, and thanks everyone else for joining us today. I'm going to talk a little bit about China, what's been going on over the next month and what's going to be going on over the next couple of months. So I've titled this one China's Uncertain Summer. Really, we've only just gotten used to the fact that Chinese demand has proved remarkably resilient, and now we're going to have to get used to a slight downturn, and the question is going to be how strong is that downturn? In terms of what we've seen so far, May still saw very close to record high demand. It did in fact see record high steel output. And May and April combined have really made up virtually all of the demand loss from the first quarter, which is quite a remarkable comeback, really. So the outlook for the year remains quite strong. But the issue that we're going into now is that May has already seen demand top out, and now we're going into June, and through June we've started to see a slight decline in construction steel demand. And there's obviously fear that that will continue over the summer, driven by rains, which reduce construction activity, hot weather, and then compounded by the fact that a very large number of imports are coming in over the next few months and could help to tip inventories higher. At this point, I'd like to run to the poll and get your opinion on prices and what impact this will have on prices. So Paul, if you could bring up the poll. Thanks. So the question is, how will a weaker supply-demand balance over the summer affect Chinese rebar prices? And we've got 4 options here. 1, prices will remain strong, by which I mean flat or rising. Prices will decrease only up to 100 renminbi per ton. Option 3, prices will decrease by 100 to 200 renminbi per ton. And option 4, prices will decrease by more than 200 renminbi a ton.
Thank you very much, Thomas. We'll let people vote. I can see at the moment that just over half of people have voted, similar speed to last time. We'll give people another 10 seconds or so. So weaker supply-demand balance over the summer affect Chinese rebar prices. 1, they'll remain strong. 2, they'll decrease, but only up to 100 Chinese yuan per ton. Prices will decrease by 100 to 200 yuan, or finally, prices will decrease by more than 200. We give you a couple of seconds there. And in 3, 2, 1, we will close the poll. And Thomas, you can interpret the results for us.
Thanks, Paul. Okay, we've got a fairly even split here, but definitely kind of middle of the road answers, which is quite in line really with what we're expecting as well, in fact. So we have a slight win for prices decreasing up to 100 renminbi a ton, but between 0 decline and 200 decline, that accounts for more than 70% of answers. So a fairly strong support for only a slight decline. 11% of people thinking there will be a more significant decline, but less than the 18% that think prices could stay flat or potentially increase. So if you can take the poll down now, Paul, and we'll go to the next slide, and we'll put that in a little bit more context. So this is what we've seen so far. So rebar and HRC prices recovering and then diverging in June. So you've seen these are our Shanghai domestic market spot prices. HRC remaining on a fairly steady uptrend, whereas rebar topped out around early June and then started declining slowly for a couple of weeks. Now that decline has been slow, so the decline so far hasn't been anything to be too concerned about. And on balance, we expect a modest decline over the summer. Certainly demand is declining, and we've seen that again so far this week in Shanghai, in particular with weather in the region dampening construction steel demand. If we look here at the warning signs that have been coming in, this is data going up to last week, and it's inventory levels. And last week we started to see the first signs of an inventory increase, which was the first real increases since the peak in February or early March, in fact. These increases in inventories have been confined so far to wire rod and rebar mill inventories. HRC inventories appear largely unaffected, and demand doesn't seem to have been too big an issue for them. But the concern in the market is whether this increase in inventories will then spread to social inventories, so inventories at traders and stockists in the domestic market. In that case, there's a possibility that prices could come under slightly more pressure. That is expected to happen at some point in the next couple of weeks, but the question is how soon and by how much do inventories increase? And there's a certain wildcard in that, and that is the level of imports, which is something that China is not really used to dealing with. It's used to having a fairly simplistic calculation of domestic supply and demand and being able to export the surplus. But in the coming 2 months, we do have a slightly unusual situation. So Chinese steel imports have been strong since the end of 2019. In particular, that is the case for semi-finished products. But we do have an increase from these levels. So if you look at this chart on the right-hand side, we only have the data up to April. But this going up to August is expected to see a fairly consistent increase. And in particular, also higher volumes of finished steel products. Semi-finished products are coming in at a very steady rate, but finished steel products are a little bit less predictable and a bit on and off. How much will actually arrive is also open to question, because we have seen bookings reported of around 9 million tons coming in over the months to the end of August. But we also have situations where some products are being diverted. So we had wire rod from Korea, for example, 2 weeks ago, was diverted to Southeast Asia after a warning from a Chinese mill that they could investigate anti-dumping duties if imports were not diverted. So how much will actually arrive remains open to question. As well as the import surge becoming partly involved in finished steel products as well as semi-finished products, we also see imports going the other way, going upstream. So not only have we had Chinese iron ore imports increasing year on year, year to date, but we've also seen this strong increase in imports of pig iron and DRI. And this has really been the result of very strong Chinese steel demand, which has kept Chinese steelmaking margins positive, but Chinese steelmaking itself has been limited. And part of that is the inability to import scrap and the insufficiency of domestic scrap supply. This is something that we highlighted in our scrap report last year, that China has banned the imports of ferrous scrap, along with other metal and plastic scraps. But its domestic supply is not sufficient as long as demand for steelmaking materials remains strong. That balance domestically is not expected to turn positive until around 2024 or 25. So this has created an imbalance where China has been unable to import sufficient materials, and instead of the obvious choice, scrap, it has been turning to DRI and pig iron imports. That whole import story, as I mentioned, is really premised on this strong demand in China. So it's worth pointing out that our forecasts for Chinese steel demand in 2020 have been revised in recent weeks, at the start of the month, in fact. And we have revised them up, not down. So that's quite an important thing to note, considering that we've had a coronavirus and we've had a shutdown and a huge impact on demand in Q1. We actually think the recovery will outpace that slowdown in Q1. So we now expect crude steel output to reach very close to 1.01 billion tons, and we expect real steel demand to be up around 2.2% to 907.5 roughly million tons this year. That has been driven by the coronavirus and the response to the coronavirus. But there's one very important thing to note, which is key in understanding China in general, which is that coronavirus has not really changed the trend of the Chinese economy. It has really only enforced and accelerated the trend in the Chinese economy, which is that China has really struggled to move away from reliance on the state to drive growth. That is really what drives steel demand. If the Chinese economy was moving healthily towards consumer demand and less dependent on investment, then steel demand would be topping out, which is structurally what should be happening. But as long as the economy is dependent on state investment, there's always this potential for steel demand to increase based on state activity. So over the year, we expect very strong demand. Important to note, that doesn't mean that we expect strong demand in the next 2 months, but it does mean that over the year, we expect strong demand. I'm going to leave it there. I look forward to your questions and maybe discussing a bit more of that later. Paul, if you'd like to come back and introduce Dan.
Thank you very much, Thomas. You'll be pleased to know that you've generated quite a few questions from that brief session there. So we'll gather those together and put those to you and the rest of the panel at the end of this session. We'll move away now from the joys of China over to our North American editor, Dan Hilliard, who's going to comment on all things North America. Dan, over to you.
Thank you, Paul. As Paul said, I am Dan Hilliard, reporting to you just outside of Pittsburgh, Pennsylvania, and I want to talk about the recovery thus far and what we're likely to see over the balance of the year. So it took a little while, but there's finally some bright spots emerging, and they seem to be more than just lens flares. We're going to talk about each of these in turn, but just briefly, while the U.S. market is nowhere near a normal baseline, whatever that might be in the post-COVID world, there are clear signs of recovery in pricing and demand. 2 sheet increases have been pushed through successfully. A third is rumored on the way. Plate has likewise seen increases, although from a much lower trough. Auto is back and doing better than expected. And the oil field is a tad less disrupted, but there are structural problems remaining there for energy tube. So on hot rolled, you can clearly see the steep drop off that occurred just about when the COVID restrictions went into place. And the chart really doesn't do it justice. We've had 2 increases now, much of it has settled, and a third increase is reportedly on the way. There's some opposition from the buying sector using the, let's say, threat of imports. I believe that's more of a symbolic thing than an actual thing, only because the lead times for imports and the still ongoing uncertainty just make them sort of a far-fetched solution unless domestic prices went truly wild and out of control. Right now, the ceiling for hot rolled is right around 540 a short ton. I feel it could fairly comfortably approach 600 without seriously provoking imports. But in this market, anything could happen, truly. Moving along now to plate. Construction never saw the big dips that she'd experienced, so plate, rebar, similar construction products never saw that giant trough that sheet has so quickly pulled itself out of. That being said, backlogs are extremely weak right now and prices are coming back, but from a less severe drop. So we should expect less momentum, slower gains, but still top level growth. The trajectory sort of seems inevitable. Right now we have A36 hovering right around 580, 590, in some places as low as 560. An increase is rumored, but we have not seen evidence of it yet, but it really wouldn't take much to boost over that psychologically important $600 a short ton barrier. I expect the next move for both plate and sheet to be scrap based rather than demand. Demand will come back very slowly as credit frees up, projects get back on track, new projects, hope upon hope, are conceived of and funded, but the raw material pressure is very real. It is kind of, again, inevitable, and I expect that to be the medium-term mover. So now for some bad news. Things have settled down in oil. The Russia-OPEC price war has mainly cooled, but it wreaked absolute havoc on CapEx budgets. This is going to be a very tough time for energy producers up and down the supply chain. The Baker Hughes rig count is at historic lows, down more than 700 from last year. Our representative OCTG price for P110 domestic welded casing has been moribund at 1,000 to 1,050 for quite some time. There's no real quick fix. The price has to improve enough to restart CapEx programs for those producers that are still left. And there's also sort of the assumption that the energy field in general is going to look a little bit different post-COVID. There's going to be an increased focus on environmentalism. There's going to be an increased focus on resiliency in markets, resiliency within companies. It's difficult to say what the post-COVID energy tube market will look like, but it's fairly safe to say that it will look very different from the market that we started the year with. So the big question is what's coming next, and the short answer is I don't know, but you probably do. So sentiment is going to be the biggest driver the next several months, excluding the nuts and bolts of raw materials. With that said, I'd like to bring up the poll. Paul? So ignoring the upcoming 4th of July holiday and summer doldrums, do you expect to begin September with demand up, demand down, or about the same?
Thank you, Dan. People are voting at the same speed each time. So at the moment, we've just over half of people have voted so far. So we'll give a further 15 seconds or so. So just to repeat the question, ignoring the upcoming holiday and summer doldrums, do you expect to begin September with demand rising, demand going down, or roughly about the same? So got 3/4 of people voted. We'll give it 5 more seconds. And we will close the poll now. Over to you, Dan.
Okay, that's not a very surprising split. September, we would naturally expect demand to be coming up, especially on a seasonal basis. The only monkey wrench that might potentially be thrown into this market is the possibility, the very real possibility, of a second wave in September. Paul, if I could bring back the slide real quick. Even in the event of a second wave, even in the event of another black swan event, I believe that confidence in the market, in price increases and lead times, sentiment in general, they're going to dictate how the market emerges from this unprecedented period of disturbance. Let's also not forget that there is an election coming up in November with all the uncertainty that usually carries with it. It's long been known in steel that prices follow sentiment and vice versa. I believe more than ever in this market, sentiment is going to be the big driver, supported, of course, by, in the medium term, scrap. It's tough to look at demand right now and make any kind of predictions about price, but we do know that raw material prices are going up, and it should lead, along with some healthy sentiment, to a generally upward trajectory, ignoring any other large disruptions. And so without further ado, I'm going to pass you along to Adam, and thank you.
Thank you very much, Dan. Adam, the floor is yours and the video is yours.
Hi guys, thank you Dan, thank you Paul. Good afternoon to everybody from sunny Frankfurt. I hope you're all keeping well. Thank you for joining. I'm going to speak today a little bit about the Middle East and touch late at the end on Turkish scrap prices and CIS billet prices. So we had the latest crude steel production figures released by World Steel yesterday, and they showed that crude steel production in the Middle East, it's actually declined for a second consecutive month by 7% year on year to 3.14 million tons. The production had been increasing for consecutive years in the Middle East. It was one of the main growing regions. So 2 consecutive months of decline shows you that it's a serious situation we're in right now. Output did rebound from April, the month before, but that was a very deep low caused by the effects of the pandemic. In Iran, however, output grew again year on year in May. Iran seems to be resistant to the, or at least steel production in Iran seems to be resistant to the COVID crisis, and the country continues on its target to try and increase crude steel production by 3 million tons this year, this Iranian year, to 30 million tons. In Qatar, we also saw production rebound in May versus April. If you remember, Qatar Steel announced at the beginning of the second quarter that it was focusing entirely on the domestic market. It was postponing exports for now because of tough competition and obviously the COVID crisis. And we saw a very low output of 48,000 tons in Qatar in April. That recovered slightly to just over 60,000 tons in May. So if you remember, we last time we spoke about in the webinar last month, one of the big stories was that Iran had introduced export restrictions, steel export restrictions. And of course, the steel producers weren't very happy about this because exports are essential to support steel production in Iran. And there was the hope that this chap here you see on your screens, the new Industry, Mine and Trade Minister, Hossein Kiabani, would maybe amend the restrictions and allow exports to happen freely again. That hasn't happened so far, and this has affected shipments abroad from Iran. In the first 2 months of the Iranian year, so the 2 months through 20th of May, Iranian semi exports fell. They halved, actually, they more than halved and finished steel exports slumped by 40%. This obviously comes at a time when COVID is limiting demand in export markets anyway, so the full effect of the restrictions, you could argue, is yet to be felt. By contrast, last Iranian years, exports from Iran, semis exports surged 26% and finished steel shipments increased by 16%. And this really supported production growth. So the Iranian Steel Producers Association has reiterated again that it wants the government to remove these export restrictions, allow exports to happen, and support the target of increasing production by 3 million tons this year. In Saudi Arabia, there was the customs authority announced at the end of May that it would increase customs tariffs for imports of various steel products into Saudi Arabia to the maximum permitted rates by the World Trade Organization, which it can do without any lengthy bureaucratic procedures or investigations or probes. It then backtracked on the eve of the implementation. It said it would postpone the increases, and then a few days ago it said no, the increases are back on. So effective from the 20th of June, the customs duty on billet has gone up to 10%, hot rolled flat products to 10 to 15%, coated flats to 12 to 15, and on long products 15 to 20%. Now, this move had been on the cards for many years now, long before COVID reared its ugly head, as a means to support local industry to increase local content use. But I mean, market participants had anticipated or guessed that the Saudi customs postponed the increase because the Saudi economy is already under a lot of pressure. It's been hit by this double whammy of the pandemic and lower oil prices, which has reduced significantly the spending plans of the Saudi government for steel-consuming infrastructure projects. For example, for this year, it's put a lot of Saudi Vision 2030 projects back by at least a year, and those projects were hoped for by all the market participants as the engine to spur the revival in Saudi demand. And VAT, it was announced already months ago by the Saudi government, will treble to 15% from the 1st of July. So you have all of these factors putting pressure on the Saudi economy. And some market participants had hoped this customs duty increase would be postponed until further notice, but it's back on. It's confirmed that it's happened from the 20th of June. So Paul, if we could run the poll now, please.
Thank you, Adam. We'll just get on the screen for you. So okay, sorry, you go ahead, Adam.
Thank you, Paul. When will GCC infrastructure spending plans get back on track is the question, and the answers are by the end of this year, the end of 2021, or the end of 2022.
Thank you, Adam. We're getting the votes coming in. It seems to be a consistent pattern of the speed at which people are voting. So once again, after 30 seconds, we're at about 65–66% of people, 2/3. We'll give that another 15 seconds or so. And it will be interesting to see whether the results that were put on the screen in a second or two, when the poll is closed, match what you would have expected yourself. So we're going to give people, votes are still trickling through, give people another 5 seconds, and then we'll close it. So we'll close it in 3, 2, 1, now. Over to you, Adam.
Thank you very much, Paul. Yep, that seems about right. Certainly by the end of this year, it's unlikely that the economy is going to go back to its sort of pre-COVID state. Next year, hopefully, the situation will rebound. Things are looking more positive. There is a big question mark over oil prices, even if the damage done by COVID-19 fades away and the economy recovers from that. Will oil prices also recover? Because if they stay low, it will still mean less oil revenue for infrastructure spending in the GCC. So I think we can be hopeful that next year things will rebound. So if you could just put it back to the slides, please, Paul. Thank you very much. So I'm going to speak briefly now about the pricing trends in Turkey and in the CIS. As many of you know, the uptrend that we've seen in the last few weeks in the Turkish scrap market came to a halt more or less last week as mills turned away from the deep sea import market after they had sourced the material that they needed. There was a HMS 8020 booking from the US at $267 per ton CFR Turkey last week. The merchant came down from its original offer earlier in the week of $270. And there were small tonnages booked at $270, but this level is generally not gaining acceptance among Turkish buyers at the moment. So it looks like for now, the Turkish prices, scrap prices, are stabilizing. In terms of the rebar export offers from Turkey, they were unchanged at the end of last week at 425 to 430 FOB Turkey. But the problem was demand. There were no deals no fresh deals to the US or to Asia. There are obviously the fears in Asia over the second wave of the virus. Singapore, buyers in Singapore still remain out of the market, and Hong Kong, which has obviously been another big buyer in recent times of Turkish rebar, was not active at all recently. So the issue is still very much on the demand side. There were small quantities sold of rebar to the traditional markets, Israel, Yemen, Africa, but again, this was at around the 425, 430 FOB level, so it doesn't look like prices are going to go any higher than that unless demand recovers. And with the CIS billet prices, the buying appetite turned softer last week after CIS mills hiked their offers, and prices in China looked weaker, and there was obviously this fear of the second COVID-19 wave. So demand softened slightly. The offers were, CIS billet offers were at 380 to 390 FOB Black Sea, and the Russian mills were booked out for July casting. Traders were saying that $360 per ton FOB is a workable price for sales to the Middle East and North Africa. And briefly with CIS hot roll coil, prices increased further last week as buyers needed material. Demand has been strong in Asia. As my colleague Tom mentioned recently, construction long steel demand has been more affected by the weakening trend, whereas flats have remained relatively unaffected. So Asia has been a good outlet for CIS coil mills in recent weeks. Briefly looking forward, what's going to happen? As my colleague Dan said, I don't know. It's impossible to forecast accurately, considering the situation is changing day to day. And this big question mark remains over the second wave. When it comes, it's a matter of when, most likely not if. Most people expect it to happen. What will the impact on demand be? You probably know better than I do. Will it be, because we're more prepared for it this time, will we be able to control it to a greater degree or not? That remains to be seen. But what is likely to happen in the Middle East, the output recovery is likely to be slow. There's an overcapacity. There was already an overcapacity, but it's been exacerbated now in the long segment in the Gulf Cooperation Council, with a new mill being commissioned in Oman recently, or due to be commissioned imminently. So we have more longs than are required. The double whammy of oil prices and COVID, which I mentioned earlier, are likely to delay the steel consumption recovery in Saudi Arabia, mainly Saudi Arabia, until after 2020, so at least next year. In terms of the project market in the UAE, what I'm hearing is that projects in Dubai, new project awards, there are very few. It doesn't look like there's going to be much going forward, but in Abu Dhabi, the situation is much more promising, and demand for construction steel there should be better. World Steel a few weeks ago came out with its delayed short-range outlook, and it had forecast more or less flat, previously more or less flat steel demand growth for the Middle East. This year, it now changed. Now it's revised its forecast to a 17% decline. So quite a significant impact from both COVID and lower oil prices. We're going to see intensified protectionism. I mentioned already the Saudi customs duty increase, but that's only a small element. There's still the results of the GCC safeguard probe to come, which will be far wider reaching and have a bigger impact on trade. And as long as demand remains good in Asia, mills in the Middle East and Turkey will look to export as much as possible to Asia to offset weaker local demand. And in Turkey, there is more optimism about Turkey because it was already, you could see, on the path to recovery before COVID hit. The year started very well. Turkish steel production and consumption increased significantly in January and February. Okay, it was from a low base. Second half 2018 and 2019 were pretty bad years, but the government implemented a lot of economic reforms, and there was the feeling that they were starting to take hold, and the economy was recovering. This has been now delayed by the pandemic, but once the situation eases, there is a feeling that that the Turkish steel consumption will rebound, and it's actually forecast. It's one of three, along with China and Vietnam, of the top 10 steel producing countries forecast to experience consumption growth in 2020 amid all of this pandemic damage. So hopefully Turkey will see a rebound soon. I hope you enjoyed the presentation. I'm available for any questions. Thank you.
Thank you very much, Adam. If I can ask Thomas, Dan, and Emanuele to jump back onto the screen. And then, as I said, we've got quite a few questions during the course of this webinar, so we'll run through as many as we can in the next 15 minutes or so. Let me just pick one here. Thomas, I mentioned that you had quite a few, and I'll start with one which is, if Chinese demand weakens over the summer, is there still potential for imports? Somebody with their eyes on exporting to China.
Yeah, sure. So the uncertainty over the summer has impacted import markets in a couple of ways. One is that the uncertainty means that buyers are less willing to accept the longer lead times. So imports from Turkey and Black Sea are slightly disadvantaged compared to imports from Southeast Asia. So there is an impact there in terms of, depending on what market you are selling from. Overall, there will still be imports, but the focus is going to be on imports that can be relied on to make a margin, which is really semi-finished products from nearby suppliers, so especially from Southeast Asia currently.
Thank you very much, Thomas. We head a little bit further west with the next question, which is for Dan. And Dan, we've seen a lot of government help from different countries in the world, and this is a really simple one that may be loaded during an election year. Is there enough credit to kickstart construction in North America?
There have been a couple attempts to get a stimulus bill passed. A stimulus bill is a slam dunk for both parties. Nobody doesn't want a stimulus bill. That being said, this being an election year, it'll be more contentious than most efforts because generally how it works is Republicans want stimulus bills that go from, let's say, the bottom up, and Democrats want a top-down approach. No one really wants to give President Trump a victory right now. There is enough money, there is enough credit. There probably is a lack of political will.
Okay, thank you, Dan. Apologies for cutting in there. Emanuele, a nice one for you regarding one of Europe's great soap operas. What will happen between ArcelorMittal and Ilva this autumn? Do you have any thoughts on where that will go?
Well, it's difficult to say exactly what will happen, but we all know where we are now. It seems every year during the summer we go back to uncertainty regarding Ilva. So the latest is that the CEO of ArcelorMittal Italy, so Mrs. Morselli, said that actually they are open to the government to come in as an investor in ArcelorMittal Italy, and this was already actually agreed between the parties when they did the last agreement for the purchase of Ilva by ArcelorMittal. The problem is that there is a clause in the contract that they signed for which ArcelorMittal could leave in autumn, could leave control of Ilva for, I think, paying 500 million euros. So a lot of people believe that ArcelorMittal is considering using this clause. We all know that the situation with Ilva for ArcelorMittal is, on one hand, they're ready to invest heavily to relaunch the production of a mill that it's clearly strategic in Europe. On the other, if they leave control, is a win-win situation, because they know at this stage, with the current market, after all the troubles that they went through, it's very unlikely that the Italian government will convince someone else to come and invest in the mill and take over. So they know that if they leave, the government will have to take the full burden of the Ilva situation, which means investing, which means relaunching production. And it's from what we learned in the past, governments in general are not that good in doing this, and the Italian government per se is not the best in doing that. So I believe that ArcelorMittal has a real interest in relaunching Ilva. Of course, all the troubles that are coming on during this trajectory, during this path, are not helping. There is the clear opportunity that ArcelorMittal will leave it. Yes, there is. I mean, they can restructure their production, they can focus in Fos-sur-Mer in the south of France, and they can still have a strong presence in Italy with their sales supplying from other mills. That's the reality.
Thank you very much, Emanuele. Always good to hear your opinion on that saga. Adam, got one here, an unusual one. Do you see the ongoing locust wave in parts of the region having some sort of indirect black swan effect on steel demand in the region?
Sorry, Paul, could you repeat that? The ongoing local what?
the plague of locusts in the region?
Having an impact on steel demand.
Yep.
It's not a structural issue. We can put it that way. So it's not going to have a big impact in the longer term. And a plague of locusts. Yeah, I'm actually going to have to look into that one and see what's going on.
I have read that in the news. It's a physical plague, not a metaphor. Yeah. Okay,
so it's actually it's literal what you're saying. Yeah, no long-term effect.
Okay, thank you. Sorry for that curveball there, but came from one of the audience. One here for Thomas. Given that in China, demand is majorly driven by the government, could you share what you see are the large projects or events which you see driving Chinese government steel demand for the next 12 months?
Yeah, sure. So the Chinese government is really absolutely key, and especially in a crisis, as is true of everywhere, but obviously to an exaggerated extent in China. I think that the key policies that are in place so far are really around financing. So in particular, stuff that we mentioned, I think, last month about the 2 sessions. So an extra 1.6 trillion renminbi in local government special bonds, an extra trillion in coronavirus bonds. There's also now talk of issuing new bonds, potentially around 800 billion renminbi for urban redevelopment, which would in effect directly subsidize construction activity, and so that could be another stimulus. But broadly speaking, it's a question of more of the same, largely bond financing going into mainly infrastructure projects, but also in supporting indebted developers. Yes, but I think it's important not to focus too much on any individual project. No individual project can really account for a large percentage of Chinese steel demand. It's the big picture that makes a difference.
Thank you. And a sort of slightly related question, but from a different person, is in the case of China, why has HRC price gone up? Is it related to auto demand?
In part. So if you look at markets sequentially, so if you're looking at month-on-month changes or week-on-week changes over the last couple of months, you've seen construction demand is really the one that's had a bit of a decline. So obviously, rebar wire rod more affected there. In a way, HRC has slightly been supported by the fact that manufacturing has been slow to recover. So manufacturing sectors are still on their recovery, and month-on-month automotive white goods production are increasing. And then the other factor is also the importance of infrastructure demand has meant that the yellow goods sector is also very strong and consuming a lot of flat products.
Thank you very much. Moving this time over to Dan, and really simple question. Adam actually alluded to this in his presentation, the second wave. Dan, what will be the consequences in North America of a second wave? What will be the impact?
Well, in the event that there's a full-on second wave with similar restrictions, well, just sector by sector, auto will likely take a hit again, and 2 big hits in a year is a little bit much to ask it to bounce back from easily. Construction will be basically frozen then through the winter and then next spring, which would be very bad for rebar longs. As far as sheet goes, if the restrictions extended to consumers and commodity goods were no longer able to be sold, yeah, we're hoping that doesn't happen.
Okay.
Yeah.
Thank you for your thoughts there, Dan. Emanuele, one for you. What kind of margin do you expect steel players in Europe to make in calendar year 2020? Given that margins already declined significantly in Q4 19, do you anticipate players to make EBITDA level loss, especially the likes of Tata Steel Europe?
Well, I cannot really say what level of EBITDA each of the companies will have, but clearly, yes, the main problem, and I think I showed it I tried to show it in my presentation, is the margins for European steelmakers at the moment. I mean, the trend of steel prices has been negative since the end of last year, and already in the results of the steel makers at the end of last year, we noticed that the margins, EBITDA, for example, for many of the players were very thin or lowering anyway. So this negative trend, together with a new rise of input costs like raw materials. Well, of course, we know that oil costs were down, but iron ore above $100, I don't think any of us would have expected this if we look back 2 months, maybe, if we look back when coronavirus started to spread around the world. So with iron ore above $100, scrap holding up, and as Adam said, the Turkish recovery is ongoing. There is an issue now with coronavirus, of course, but Turkey was on track to recover after a terrible 12 to 15 months between end of 2018 and 2019. So yes, I think the real issue for steelmakers is profitability, and this is the reason why, to be very honest, they're hitting so hard on the safeguard measures, which are, of course, I mean, they've always been interested in it, but at the moment, the request that Eurofair did at the beginning during the coronavirus emergency with a 75% slash on quotas was, of course, enormous given even given the situation. And it's clear that there is a real concern among steelmakers for their profitability. So they really are looking at all ways possible to rebound. I mean, the safe line can come, on the other hand, from Asia, where we've seen the market rebounding quicker than we were expecting. So looking towards East, we could actually say that the market can respond rebounding better than we anticipate. And we now need in Europe to fix all the problems that were starting at the end of 2009. So automotive demand for sure needs to be helped or supported or in some way. But the only thing I can say is this: I cannot say how much EBITDA each of the companies will do, but definitely 2020 will be a very difficult year in that sense.
Thank you for that. I've just noticed a question. It came in a few minutes ago, but I've just noticed it while you're talking about that type of thing. Somebody's asked a question: is there still a chance for Tata Steel Europe to merge with ThyssenKrupp after a failed first attempt?
The chance is always there. We know anything can happen with ThyssenKrupp in particular. It's very unlikely. I mean, you all know that Tata Steel is going through its own troubles, let's say. So after 28 years, we have the first strikes in IJmuiden in the Netherlands. It's been 2 weeks that workers in IJmuiden are stopping liquid steel production or some finishing lines every day. So Tata Steel is definitely working hard to reorganize the whole system, and Dutch workers are complaining, let's say, are demonstrating, because they do not want a full integration with the UK business, which is considered less profitable than the Dutch one. So I would say the reality is, even at the beginning, the agreement between ThyssenKrupp and Tata Steel never took off, because trade unions, both in Germany and in the Netherlands, were very strong and were always opposed it in a way or anyway, tried to have a strong stance in it. It seems that the situation has not changed that much. So I wouldn't say that this is the real, it's unlikely that something has changed so dramatically to allow them to merge. ThyssenKrupp is in the market, we know, so something will happen. I don't really see Tata Steel being ready for that, but I mean, we heard one British man, for example, British Indian man that did a lot of expansion of his company during the last 12 months. maybe we should look in that direction, in my opinion.
Okay, thank you, Emanuele. We'll follow up on that one in a few months' time, I imagine. Got one here for both Adam and Thomas, which is India has turned into a net importer for China. Do you expect this to continue for some more months? First, on the Chinese perspective from Thomas, then we'll go to you, Adam.
Sorry, was that on Chinese imports? Was that? I didn't quite get the question clearly.
Yes, I'll repeat it. India has turned into a net importer for China. Do you expect this to continue for some more months?
So yeah, China is buying up quite a lot of billet, especially from India at the moment, and we reported some new deals in the last few days as well. And that is likely to continue, I think, for the moment. I mean, as I said before, the opportunity to sell billet especially, but semis in general into China is likely to remain open, even with a slight decline in rebar prices in China. A larger decline in rebar prices in China might cut it off, but for the moment, that doesn't look like it's going to be the case. And in terms of India itself, I think Adam can share more, but the coronavirus situation, there still seems to have issues, and there still seems to be issues with domestic demand. And so I would be surprised if there wasn't Indian material available in the next several months.
Thank you, Thomas.
Yeah,
Adam?
I'll certainly echo what Tom said there at the end. As long as there is demand from China, then India will continue to export there. It will continue to export anywhere it can, actually, because at the moment domestic demand is very subdued, mainly because of the COVID crisis. Obviously, we have the monsoon season coming up as well, which subdues demand every year typically. The growth rates, the growth forecasts for Indian steel consumption was very positive last year, but since the COVID pandemic has struck, it's been revised and it's looking very negative now. So most observers are saying that demand will probably recover from the December quarter, hopefully, and then Indian mills will redirect more exports to the local market. But for now, in order to maintain production and utilization, they're going to have to continue exporting to offset weak local demand, for sure.
Thank you very much, gents. Dan, moving over to North America, a question for you. Do you think there will be a higher demand of HRCR HDG sheet than what the mills will be able to cover in time, brackets, considering their lead times?
Short answer, no. We've heard mixed things about the mill lead times, but one thing that's fairly certain is that they're approaching normalcy. They're in no way overextended. And in a lot of situations, they could easily fix that by just bringing capacity back on, not just by restarting a facility, but by adding shifts. So I don't think there's going to be a supply side crunch, no.
Thank you very much. Maybe try that in the poll next month. Thomas, might be our final question. A very specific question. A planned $1 billion integrated steel mill project was cancelled in Malaysia last month. Will it be the same in other countries? Because we know there's a lot of planned investment in steel mills in Southeast Asia. You've talked about this in the past.
Yeah, so Southeast Asia has, it was attracting a huge amount of investment because it has a structural deficit in steel. It was a net importer of around 70 million tons in 2018. But the level of investment has increased to levels that were not sustainable even before the COVID crisis. So it was inevitable that some projects will fall by the wayside, some projects will be delayed, and some projects will start and not be profitable. So the more important thing, I think, is to look at which plants have a natural advantage. Some obviously really stand out, like Tsingshan stainless plant in Indonesia, which has a structural advantage in costs. But many of the others are entering into a very, very competitive environment, in particular some of the large blast furnace based producers coming up and recently commissioned in Malaysia and Indonesia, which are entering oversupplied longs markets. They're very reliant on exports, and really they will struggle to make money if we have a crisis, at least until they're whittled down a little bit. So yes, there will be other plants that go ahead, I think.
Brilliant. Thank you very much, Thomas. I promised at the beginning that this webinar would last about 75 minutes, and in my reckoning, we're on 73. So I think we'll wrap up there. I'd like to thank all of you for attending today. It's been really good to be able to maintain some sort of contact with people at a time when our conferences are compromised. We're not finding it easy to travel. So obviously face-to-face interaction is extremely limited. But I'd like to thank you all for spending an hour or so with us this afternoon. I'd like to thank all of my colleagues for their input and their presentation. So Adam, Emanuele, Dan, Thomas, thank you very much. We'll be sending an email out later today, which will allow you to give us some feedback and tell us your thoughts on what you liked, what you think we could improve upon, any topics for future inclusion. There'll also be a link to the video of this session if you want to watch anything back to get some more information, or you want to forward it to any of your colleagues. Please feel welcome. We'll repeat this session again at the end of next month. I think at the moment we're aiming for the 22nd of July, probably around this time of day. We'll confirm that in an email very shortly. And other than that, all that it remains for me to do is to say thank you once again. Hope you all stay safe. Hope you and your families are doing okay and your companies are keeping going. And we hope to hear from you all and see you all in the near future. Thank you very much and goodbye.
Thank you.
Thank you. Bye-bye.
Thank you. Bye.